The almighty credit scores. Three digits that show the rest of the world how responsible you are with money, and if you can be trusted with somebody else's. The three digits which decide the size of your house, the luxury of your car, and how much interest you owe to another party. These numbers are important, and it's crucial to understand how they work. More importantly, how you can make these numbers work for you. The purpose of this video is the following. I'd like to teach you the origin and structure of the US-based credit scoring model, to explain the importance of this score, to demonstrate effective means to boost the score, and finally, what to avoid to protect the score that you build with the preceding sections. Now, these are the steps that I've taken on my personal journey when I was starting my credit journey about a half decade ago, and I hope they help you, even if it's just one thing that you hear from me today. So the origin of the credit score began really with human history. For the majority of human history, there was no such thing as a credit score. If you wanted money, or fiat, and that's a topic for another time, you needed to either ask somebody you knew, or provided a service to someone who was willing to pay you for it over time. And as time went on, the banking system emerged as a de facto method to make this process more efficient. The result for everyday people was easier access to capital at the cost of dealing with a banker. And the banker in years past was more like the stereotypical image of the one held in the 1950s. Cynical, judgmental, and reluctant to extend credit, the banker was someone that you needed to form a relationship with, as there was no consistent model for determining someone's willingness to repay a loan. The banker had to personally decide if someone was trustworthy enough to take on the risk of giving them said loan. There were two main problems with this model of lending. Firstly, it relied heavily on the ability of the individual banker to make a good decision for the firm. However, this presented risks of corruption, under the table dealings, and other factors which put the bank at risk. The second problem was the risk of discrimination, where the banker would extend out credit not based on the customer's ability to repay back the loan, but instead on things like race and ethnic origin. This is where Bill Fair and Earl Isaac come into the story. The pair of statistics made several widely available accepted correlations where they could predict if a person was willing to repay their debts. And for the most part, their predictions were accurate, and slowly became the modern credit score system that we use today. While it wasn't fully accepted as a common practice until the 1970s and the creation of the FICO score, the same system that we use today is the same one that they used at that time. Now, let's get into why credit scores are important. Most people think about their credit score in relation to their car payment or their mortgage, and there are many different types of debt, and they require many different types of risk management. So your credit score impacts almost every aspect of your ability to get debt in this economy. For example, the worse your credit is when applying for things like homeowners insurance, the higher the fees and interest you'll likely have to pay back to the broker. Employers check your credit score. While somewhat controversial, it is becoming increasingly common for an employer to check your score to better gauge how responsible you are. And at the end of the day, we all need access to credit. Accordingly, improving your score means getting a lower interest rate, better deals, and potentially access to leverage to make more money with. When we think about how a credit score is created, we need to think of 5 main factors. 35% is made of your payment history, 10% comes from your credit mix, another 10% comes from new credit, 30% comes from the amounts owed, and 15%, this is the last one, is made from your FICO score factors, which is a proprietary model. Of course it is. Ideally, you want a wide mix of credit types, such as student loans, auto loans, credit cards, and others for a lender to see you as responsible enough to give you discounts for things like lower rates, reduced fees, and a higher loan amount. Now, getting into the bread and butter of this article, let's talk about some methods to improve your credit score. I know people like short-term fixes, and we can get into some of those in the preceding section of this video, But let's get into, firstly, the long-term methods, and these are the most important. First and foremost, you need to get a copy of your credit report. For you to improve your score, you need to know what it is. Many websites like Credit Karma, Experian, and Mint can help you access your score. Moreover, through websites like Experian, you're allowed to access your credit score for free once a year. I personally recommend Credit Karma to start, but be advised the website isn't directly looking at your FICO score, which is the primary scoring model that people are going to use to extend your credit. Instead, the number shown on Credit Karma is another credit monitoring model, which closely tracks your FICO score. Now, the second method to improve your credit score over the long term is going to be disputing credit report errors. Once you have access to your credit report, there will be a few things you need to take note of. The report should have your name, aliases you've used throughout your life, your date of birth, your social security number, among other important information. Please ensure that the most up-to-date information is provided, as if that is not the case for your creditors who you want to establish a relationship with, they do not have the required information to contact you. In this next section of the video, we're going to talk about the model and the numbers used to calculate this, but write down this model and the score later and commit it to memory, so you're going to need this later. Now, the next section and the next step you need to take to boost your credit score in the long term is to avoid impulsive credit card purchases. One of the biggest aspects of your credit score is your utilization rate. While you're technically allowed to use your full line of credit for something like a credit card, anything above a 30% utilization rate will negatively impact your score. The goal here is, if you are above 30% credit utilization, is to pay off the balances of those revolving lines and get them under the 30% threshold. While cutting expenses and entertainment will not be fun during this period, gaining a better long-term financial future is worth the cost. Now, the next step we need to take, once we get our utilization back under control, is to pay off past due balances in full. So, once you get underneath that 30% threshold, you need to pay off all high interest balances that you have. These are likely going to just be your credit card, or if you were unfortunate enough to have to use a payday loan or a short-term loan, you will need to pay that off. You need to make sure these balances are paid off in full, no matter how much time it takes to do this. Next step, avoid new credit applications, at least for a time. As discussed earlier, another big aspect of your score are the hard inquiries on your report. These show lenders how much and how frequently you are seeking out credit. The goal here is to avoid having more than one or two hard inquiries added to your report at any given time. The more inquiries that are on your credit account, the more risky of a borrower you're going to appear to a lender, which is going to make them less likely to extend credit to you. Hard inquiries will come from applying for a new card, an auto loan, a mortgage, etc. Unless you're planning a big purchase and you have the means to sustain the minimum monthly payment, plus some cushion for a financial hardship in your budget, think about a 6-month emergency fund, avoid opening the new card. Third, and this one is key, you need to leave your accounts open. While it is best to be actively using a credit account, credit card, personal loan, etc., to show your ability to repay, there are some cases when you may want to consider closing a line of credit. Perhaps you found a better card and no longer want to use the one that you have. And the issue is, though, if you close that account, the overall average age of your credit is lowered. The best bet is to keep those first few cards that you got and to use them for the occasional small purchase. In my case, I go to Dollar Tree on a quarterly basis, and I have 16 credit cards. When I go there, I purchase one thing at a time. Maybe a Monster, a bag of chips, some popcorn, and with each card, I make that single purchase, and it ensures the card is still reported to the credit bureaus, and it makes it so the lenders think you are actively using the card, meaning they never shut it down, and the average age of your accounts continues to increase. Now, regarding the card that you use most often, you need to treat this card as a debit card and pay off the balance in full every time you use them. So you avoid paying interest, and the lending agency never closes that account. As an extension to this, avoid opening a line of credit that you don't plan on using in the long term. As an example, I use my Discover card to pay my electricity bill, which gives me the convenience of doing this with a card, and it allows that account to stay open and continues to age. Most importantly, the older of all your accounts, the most trustworthy lender, or the most trustworthy of a borrower, you're going to be seen as a lender, seen to a lender. Now, let's talk about some short-term methods, and I'm sure you all wanted to watch this video to not only hear me ramble, but to hear about these methods as well. While, the previously mentioned section about long-term credit boosting methods are very important, we need to think about developing relationships and improving your score over the short term as well, in the event that, say, you got yourself into a hole, your score is sitting at 550 to 600. Now, these options entail some risk towards your score if you're not approaching them carefully, so I want to make sure that you're aware of this prior to beginning any of these methods. The general boost, if you do the following properly and payments are consistently made, can range from 100 to 200 points if you had a poor score, and 20 to 50 if you have good credit. To put this into context, the difference in rates from going from a 600 credit score to a 700 credit score, that 100 boost point that I was just talking about, is substantial. We're talking about having a mortgage either at 7% or 5% today. And while it isn't necessary to get your credit score above the 760 to 780 range, for those who are struggling in the 720s to 740s, with a 20 to 50% boost, or not 50%, oh my goodness, 20 to 50 point boost, you're going to see some massive savings as far as rates lenders are willing to give you. Now, the first method is Experian Boost. Experian is one of the 3 main credit agencies and has recently launched a feature called Experian Boost to instantly raise your credit score by reporting things like your phone bills, utilities, popular streaming services, aka Netflix. You can boost your score by having more open lines of credit reported to the bureau and on-time payments in your report. Now, using this service also gives you access to your current Experian score, and it can let you have credit monitoring and alerts. From registration to connecting your bank accounts, expect a 15-minute time commitment and a 50 to 100 score boost, depending on what you do and what your current score is. You need to understand, prior to doing this, you should not, and I repeat, you should not report accounts that you are delinquent in. I warned you. Now, many people in America do not own their home they are currently renting, and I want to make it aware to you today that you can actually report your rent payments to the credit bureau. This is through a fintech called Boom Rent Reporting. Like Experian Boost, Boom Reporting allows you to open a new line of credit based on your rent payments. To do this, you need to pay your rent on time, of course, to avoid negative reports being added to your account, and to download a copy of your lease agreement and go through the registration process, which took me about, say, 15 minutes to complete. Once they have all of this information and they confirm your lease with the current owner of your apartment, condo, etc., in about 10 days you should see a boost to your FICO score. The range of the boost depends on how long you've rented, so you should expect to see a range of between 10 to 30 points. Now, for those who haven't gotten a credit card before, or haven't had any types of installment loans, you may want to consider self-lender as the next method to boost your credit score. This is a interesting, relatively new product that's come out into the market. By providing a CD or a certificate of deposit account that reports to the credit bureau, these accounts help you build credit if you currently don't have a score or have damaged your score. After paying an initial $9 introduction fee, you can make payments starting at a minimum of $25 a month, take 5 Starbucks cups of coffee, and the timelines in which you'll have to repay or pay into your CD will depend on the type of CD that you choose to invest in. This option isn't for everyone, and I do want to make that clear, as it depends very closely on the budget that you have to see if you can reasonably do this. However, for those that have proceeded, they've seen a score boost of between 25 and 60 points, depending on the time and the length of policy that they choose. Now, this one is a classic one, the next one I'm going to talk about, and that is consolidating your debt. The goal of consolidating your debt is to pay a lower overall interest rate by getting a personal loan to pay off other lines of more expensive credit. So let me walk you through a hypothetical. You currently owe $25,000 on 4 different cards that have an average interest rate of 25%. Upstart, as an example, can give you a personal loan today to pay off this $25,000 debt on your credit cards with an interest of 10%. Over the course of the personal loan, while paying the same amount of principal, not considering the origination fee of the personal loan, you avoid paying that 15% interest spread between 10 and 25%. At smaller amounts, this option may not make sense. You can just pay it off in the credit card, right? If you have the means to do so. However, a lot of people have considerable credit card debt. Think about those trips to the club or buying a Gucci handbag, which you probably didn't need. And if you have that situation, this may help you save thousands of dollars on interest. The key here is if you were to proceed with this option, you need to ensure that you don't open any additional lines of credit once you get the loan. Focus your efforts on paying off that line and then opening new lines of credit once done. I want to make you aware if you were to proceed with any kind of credit card consolidation, this method may potentially lower your score as it's going to require a hard inquiry, and you would have to close other lines of credit as they would not actively be used. But over the course of the personal loan, given your current, any damage done to your score is going to be reversed, and your overall debt utilization rate will go down. Now, I just want to conclude this video with a few things to avoid. The above and the things we've discussed so far is as comprehensive as it gets if you're doing this solo. We all start somewhere, and a part of me wishes that this kind of information was taught in the public school. A big part of the reason why I've put together Rags to Riches is I think financial literacy is one of the most important things you can have, especially in the modern day, with things like ChatGPT coming up, which is raising questions about the labor market and if we're all going to have jobs in 5 years, with things like inflation making it so that things are unaffordable, with wages not increasing in line with said inflation. There's a plethora of things that we could discuss in this video which are not to the purview regarding credit scores. But to wrap up, financial literacy is extremely important, and one of the core tenets of financial literacy is credit. So I hope you have gotten some value out of this video. Please be sure to like, subscribe, and share this content if you found it valuable. I hope that you continue to boost your score, and I wish you the best. Let's make it so our rags turn into riches.